When markets drop, fear rises. In the world of options, that fear often shows up as richer put premiums. But selling premium without risk controls can be dangerous. Today, we'll explain puts and how a bull put spread defines your risk. First, what exactly is a put option? Simply put, it's a contract that gives the buyer a right. It's the right, but not the obligation, to sell shares of a stock at a specific strike price before a certain expiration date. Let's use a simple example. Imagine a stock is trading at $50 and you hold a $45 put option. If the stock drops below $45, you have the right to sell those shares for $45, even if the market price is lower. Now, let's compare buying versus selling. Buying a put is typically a bearish or protective move. You're paying for the right to sell. But selling a put is a different story. It's a bullish to neutral trade. As the seller, you're collecting a premium, but you're accepting the obligation to buy the shares if assigned. You're essentially getting paid to wait and potentially buy the stock at a lower price. Why does fear matter here? Well, fear increases option premiums. When markets get shaky, people want protection. This increased demand and rising implied volatility push put prices higher, especially during a sharp market pullback. That's the fear premium. As a seller, you want to collect that rich premium when the market is most nervous. However, selling a put alone, a naked put, carries substantial downside risk if the stock falls sharply towards zero. That's where the bull put vertical spread comes in. It's a way to sell fear while strictly defining your risk. You sell one higher strike put and simultaneously buy one lower strike put with the same expiration date. Let's look at a stock near $50. You sell the $45 put and buy the $40 put. You receive a net credit for this trade. That credit is your maximum potential profit. But the lower put you bought protects you. Your max risk is now the width of the strikes minus the credit collected. Even if the stock goes to zero, the long put at $40 caps your losses. Your risk is fully defined from the start. Let's walk through the numbers. Suppose you sell the 45 put and buy the 40 put for a $1 net credit. Since each contract covers 100 shares, your max profit is $100 per spread before fees. The spread is $5 wide. Subtract the $1 you collected, and your max risk is $400 per spread. Your break-even point is $44. That's the short strike minus the credit you received. So when do you win? You profit if the stock stays above $45 by expiration. The trade benefits if the stock goes up, stays sideways, or even if it drops slightly, as long as it's above your short strike. But what if you're wrong? You start to lose money if the stock falls below your break-even point of 44. If the stock is below 40 at expiration, you hit your maximum loss. No matter how much further it falls, the loss stops there. This brings us to the core philosophy: sell the fear. It's not about predicting the market perfectly every time. It's about understanding that fear expands premiums. We wait for those moments of uncertainty to sell rich premium. We choose our levels intentionally, define our risk with spreads, and keep our position sizes small. Discipline means accepting that losses will happen. The goal is to manage them so they don't derail your long-term plan. Let's talk risk management. First, never risk money you can't afford to lose. Keep your position sizes small. Second, always have an exit plan before you enter. Respect major news events and earnings that can cause gaps. Third, avoid concentration. Spreading your trades across different sectors reduces your exposure to any single stock, though market-wide moves can still happen. If you want a deeper framework for this approach, the Sell the Fear book is available now on Amazon. And for tools and templates designed around this philosophy, check out the STF Trade Desk on Etsy. To recap, puts are powerful tools. By selling fear through bull put spreads, you define your risk and trade with discipline. Thank you for watching. Remember, the best trade is the one you can manage with a clear head. This video is for education only and is not financial advice. Options involve risk and are not suitable for every investor. Always do your own research.